Hi class. In this video we're going to look at an example from chapter 24 and how to do a statement of cash flow. So I think these are some of the harder things that you have to do in accounting. So I'll try to go through it in such a way that maybe it'll make a little bit of sense. So it says we've got a comparative balance sheet for long company and a condensed income statement. So there's that. We've got some additional information. And it says prepare a statement of cash flows for 2019. And we've got a template here for our cash flow statement. So the first thing to notice is that there's three sections to this cash flow statement. We've got cash flows from financing activities at the bottom, cash flows from investing activities in the middle, and cash flows from operating activities at the top. So in the top section, we're looking at money that was provided from operations, and that comes in the form of net income. So we're going to start with our net income. Let's see right here, $61,375. Now we know that that is money that was provided from operations for the year. However, net income does not necessarily equal cash flow. There are some things that can cause net income to go up or down that may be non-cash items. And an example of that is depreciation. So if we look up here at our condensed income statement, we've got a depreciation expense that's recorded there, and that affected our net income. But depreciation is not a cash expense. The cash happened when we bought whatever the asset was that we're depreciating. So it happened, if we bought a truck, we paid out money for that truck. That's when the cash actually went out of the company. We spread that expense over several years, but the cash doesn't go out each year when we record depreciation. The cash only goes out when we actually purchase the asset, whether it's truck or building or equipment, whatever it was. So we actually have a depreciation expense in our income statement that we need to consider. So that's $8,300. That $8,300 reduced our net income because it's an expense, but it's not a cash expense. So we're going to add back any non-cash expenses back into this area of our statement of cash flows. So we're going to put depreciation on there. We're going to add back the amount of depreciation. Let's see what else we got. Again, looking at our income statement, cost of goods sold, that's a cash expense. We already did depreciation. Selling and administrative expenses are cash expenses. Interest is cash. Loss on sale of equipment. We're actually, anytime we have a gain or a loss, we're going to consider that as an adjustment on our statement of cash flows. So we need to do something with this. So we're going to come down here. And we're going to find loss on sale of equipment. And I didn't pay any attention to how much it was. Let's see, $21,500. We're going to add back that loss on that sale. If this had been a gain on the sale of equipment, we would do the same thing, except for it would say gain over here. And if it was a gain, we would subtract that. That would be a negative adjustment to our net income. Let's see. And then I think there was only one more. Income tax expense, that is a cash expense, so we don't have to do anything with that. So when we're looking at our condensed income statement, we're looking for gains or losses, and anything that's a non-cash expense, which in this case would be depreciation. Looks like that's all we have on the income statement that we need to adjust for in terms of our statement of our cash flows from operating activities. So at this point, we're going to go up here and we're going to look at our balance sheet, because there's some adjustments that we're going to make that we're going to have to find on our balance sheet. And one of those, well, let's just look at the start at the top. On cash, we're not going to adjust for cash. The statement that we're doing is about finding out what the difference or what what made up this difference in cash from 2018 and 2019. So we should wind up with this number, but that we're not making any adjustments for cash. It's the total point of the financial statement that we're doing is to come up with this number. So we're going to move down to the next one. Accounts receivable. Looks like accounts receivable went up. And honestly, when you're doing a statement of cash flows, I think the best thing to do is to make a list of the different types of adjustments you're going to make, and then put add or subtract next to them. So accounts receivable, when accounts receivable increases, and this one actually increased by 18,400. When accounts receivable increases, you have to do a subtraction in the cash flows from operating activities. So let me find increase in accounts receivable. So increase in accounts receivable, this is a minus. A decrease in accounts receivable, this would be a plus. So like I said, I would make a list and put and summarize these things. Increase in accounts receivable, do a minus. Decrease, do a plus. The reason that is a minus, let's see if I can try to explain this. When we record sales, those sales, for example here, those revenue are recorded in our income statement, whether they're cash sales or credit sales. So this net income includes all sales regardless of whether we got cash for them or not. Every sale is in this net income. So we're going to actually have to adjust for sales that were not cash sales. And to do that, we have to know what happened to our accounts receivable account. So some of the accounts receivable that we collected this year are from monies that people owed us from the previous year, and then some of accounts receivable that we collect this year will be for this year. So when we get payments on account, it could be from this year, it could be from last year. So we've got to consider both of those years when we're considering what effect those things have on our cash flow, because we could have collected money that was owed from last year, which would not show up at all in the revenue for this year because it was sales from last year. So when our accounts receivable goes up, it means that people owe us more now than they did before. So in essence, they owed us some monies from last year, which we still don't have in cash, plus some from this year. So the amount of that fluctuation, we have to take into consideration that is the amount of revenues that we didn't actually get paid for in cash. So I hope that made sense. This is one of the hard things to explain in accounting. If it doesn't make sense, the fail-safe is keep your list, like I mentioned. Increase in accounts receivable equals a minus. All right, so let's go back up here. The next thing we have is merchandise inventory, and there is a fluctuation in merchandise inventory. It looks like it went up. So I'm just trying to take the difference in those two numbers. So it's an $8,300 increase. So we got an increase in merchandise inventory. An increase in merchandise inventory is also a subtraction for the same reason. That would be ultimately considered in your cost of goods sold. So when we consider cost of goods sold, we may have inventory left over from last year that we use this year, and that's why we have to adjust for the difference in merchandise inventory. All right, so let's see what else we've got. Go back up to our balance sheet. We've got an increase in prepaid rent. There's some difference in land. There's some difference in property and plant and equipment. There's some differences in bonds. So we're going to start with the prepaid rent. And it was $4,150, and now it's $4,800. So it increased by $650. So we've got an increase in prepaid rent. And that increase in prepaid rent is another subtraction to the net income. So you can see we're going down through the balance sheet, and these assets that are increased from one year to the next are actually subtractions. All right, let's go back up here. So we've got a difference in land, property, plant, and equipment, and bonds. Land, property, plant, and equipment, and bonds are considered either financing or investing activities, which will go into another part of our statement of cash flow. So I'm going to skip those for now, and we'll come back to those. So we've taken care of the operating assets from the balance sheet. So let's look at our liabilities. We've got accounts payable, and accounts payable is something on the balance sheet that is the result of operations. So this goes in our operating section of our cash flow statement. It looks like our accounts payable went down. So we've got a decrease in accounts payable. And that is $19,950. If I just take the difference in the 2 years. All right, so this one works a little bit different. A decrease in accounts payable is a minus. If this was an increase, it'd be a plus. So this is, you can see, working the opposite of these assets up here. The increase in assets were minuses. An increase in a liability would be a positive, and then the decrease is a minus. So it works the opposite, just like it does on the balance sheet, actually, and in the journal. We've got an income tax payable of $10,200. It was last year, and this year it's $9,600. So we've got a decrease in income tax payable. So we're going to go down here. I can find it. And it's $600. It's a liability. It works the same as the accounts payable, so it's a liability that has decreased from one year to the next, so it's a subtraction. And then back up here to our balance sheet. Bond is not considered operations. It's considered either an investing or financing, and like I said, we're going to go back to land, investments, property. We're going to go back to bonds, and they go in a different part of our statement of cash flows. And then at that point, we're into stockholders' equity, and nothing in stockholders' equity is going to be in the statement of section that has cash flows from operating activities. So it looks like we finished the first section. We start with the net income, and then we're making adjustments to that net income to convert that accrual net income into actually this is a positive. So it looks like from our operations, we were provided $43,275 in cash. So this is net cash provided. If this was a negative, it'd be net cash used. All right, so then we have another section. This is cash flows from investing. So we're going to go back up. Now, assets that we own, that we buy for use in the business, such as land and property, plant, and equipment, those are considered investments. So it looks like we've got a fluctuation in land for some reason of $39,000. Oh, yeah, down here it says, in our additional information, acquired land at a cost of $39,000 and issued half of that in common stock. All right, so our land purchase of land, $39,000. Whoops, and that should be a minus because we actually we purchased it, so that's cash going out. And we had some equipment up here. It was $212,000 before, and now it's $185,500. So there's a $26,500 difference in equipment, and actually went down. So let's look at our other information and see what it tells us. It says we sold equipment for $13,000 in cash. The original cost was $41,000. Depreciation of $6,500 had been taken. The remaining change in the property, plant, and equipment represents a purchase of equipment for cash. All right, so we sold equipment for $13,000 that cost $41,000. So I'll have to get me a scratch sheet of paper here. So we had $41,000 in that account that should have gone, that we would have credited the equipment account, because we record equipment at original purchase price, and it stays in there at that cost the whole time until we sell it. So we credited equipment $41,000 when we sold that equipment. And then we had a purchase of equipment for cash. So the difference in that equipment account, let's see, went down $26,500. That's just the difference in here and here. And let's go back to what it said. Sold equipment for $13,000. All right. So it looks like we had $26,500 in change, plus that equipment that we sold. Let's try that and see if I'm reading this right. Oh, proceeds from sale of equipment. Was, excuse me, $13,000 in cash. And then we purchased equipment. I'm not sure if this is what it's saying or not. Let's try this and see if I've got my numbers right. No, I do not. All right, let's go back to our land. Let's see, acquired land at a cost of $39,000. Oh, paid half of it in cash, so $39,000. The cash part was $19,500, which was a cash outflow, so that's a negative. Let's see if that fixed that one. Oh, good. All right, and then we purchased equipment. I'll have to think about this one here. Let's see. So back up here, we had $212,000, and we went down $185,000. It would help if I could work my calculator. So we started with $212,000. We sold equipment that the original cost was $41,000, which would give us $171,000 in equipment. So all I did was take the $212,000 and subtract out the $41,000 cost of the equipment. So I get $171,000 as the balance after that sale. But now the balance is $185,500. So we we've got. If we started at 171,000 and we ended up with 185,500, looks like $14,500 difference. And that is a purchase, so it's cash going out. Oops. All right, let's see if that fixed it. Yay. All right, so what I did, just to make that clear, I calculated the difference in fluctuation from 2018 to 2019 in property, plant, and equipment. But I had to consider the purchase of equipment and the sale of equipment. So to do that, I took the $212,000 that I started with, subtracted out the $41,000 cost of equipment that I sold. That gives me a new balance after that sale. And I know that new balance then changed up to $185,500. So I took the difference in those two, and that gave me the $14,500, which is actually the purchase of equipment. All right, sorry about that. Sometimes these aren't real clear. What am I forgetting? All right, so then in our other additional information, and also in our balance sheet, we look up at the balance sheet. We've now worked through all these assets. We took care of land, property, plant, and equipment. You don't have to worry about accumulated depreciation because we took care of that with using the depreciation. We've got an investment here in TVA bonds, and there's a change in that. So that is an investment in bonds that are not this company's bonds. This company is a long company. So they've bought bonds in TVA. So it looks like they've sold some bonds. Does it say down here? Yeah. Sold bond investment costing $13,000 at no gain or loss during the year. So there's no gain or loss associated with those, but we got $13,000 in cash from that sale of bond investment. And that's an investment, so it's going to go in here in the investing activities. Probably have a sale in bonds, proceeds from sale of bond investment. There we go. And I think it said we got $13,000. Let's check and make sure I read that one right. That looks good. Let's go back to my question. And you'll notice there's a blank line in that operating activity. There's also one in the investing activities. We have a subtotal here. That is a minus. It means we've paid out more in actual cash from our investments than we actually brought in from our investments. So that is net cash used in investing activities. And that second part is finished. All right, so if we go back up here and look at our balance sheet, we've accounted for everything all the way down to our investment in TVA bonds. So all of our assets are taken care of. In our liabilities, we already did accounts payable, income tax payable. There's a bonds payable here, and that is actually a bond for our company. We owe money on that. It looks like we started out owing $93,000, and now we owe $126,000. So we must have issued additional bonds because we owe more money on those bonds. Let's see, does it say anything down here? Issued bonds payable at par value for cash. So the issuance of those bonds is the difference between the $93,000 and the $126,000, $33,000. And that is a financing activity. Anytime the company sells or buys, anytime they do anything with their own bonds or their own stock, or if they borrow money from some other entities, like they have a mortgage or a loan, any kind of debt like that, it's going to go in financing activities. So this was proceeds from issuance of bonds. And we actually got money. We issued bonds. People gave us money, so that's a positive amount. And let's see what else we've got. That gets us all the way down to those liabilities. we don't have to, we're not going to do anything here. Let's look at our additional information. We've taken care of A, B, C, D, so we're down at E. We paid $16,500 cash dividends on the common stock. Let's see. That's a cash payment going out, so that's a decrease in cash. So that's going to be a minus. That's a payment of dividend. And I think that's it. So there's actually a blank line here. Again, we've got another subtotal. That's a positive amount, so that is cash provided by financing activities. And that completes the three main sections of the statement of cash flows. Now at this point, we're going to reconcile the beginning cash with the ending cash. All right, so here we've got either a net increase or a net decrease in cash. So I'm not sure yet. I just guessed as an increase. So to figure that amount, we're going to have to look at how much was provided in the three different categories. So net cash provided in operating activities was $43,275. That was cash coming in from operations. The next section says we used $8,000. So that's a subtraction. And then the final category was cash provided of $16,500, so that's a positive. So it looks like we have a net increase in cash of $51,775. So we are going to show how that cash affected our cash account. So we're going to start with our beginning cash and our ending cash. Our beginning cash on January the 1st, you're going to go up to your balance sheet. We're doing 2019 here. Beginning cash would actually be your ending cash from 2018, so $50,100. And that calculated the ending cash, $101,875. Let's hope that, yay. It should match your ending cash up here. So this number up here for cash should tie to this cash number right there. So when you check your work, we hope you see lots of green checks. Should look something like that. Just to kind of summarize the process, you're going to start with your net income. In this version of the statement of cash flows, you're going to start with your net income. You're going to make adjustments to that net income for anything that would have affected or basically changing that accrual net income to cash net income. So we looked at our income statement. We found things on our income statement that were included in net income that were either non-cash items, which was that depreciation, or a gain or a loss, and we had one of those. And then everything else came from either the asset or the liability section of your balance sheet. So these were differences. And as I said, to me, the easiest thing to do is to kind of keep a list of what causes this to go up and what causes these to go down. So that's your statement. That's your cash flows from operating activities. Cash flows from investing activities would be the purchase of fixed assets, either land, building, equipment, vehicles, whatever it is. The purchase of any kind of fixed asset or the sale of a fixed asset. It can also include the purchase or the sale of an investment in another entity. So right here we had proceeds from a sale of bond investment. So this came from the extra information that we had and from the balance sheet. So you can look at the balance sheet and look at fluctuations in those fixed assets. Look for fluctuations in investments, and that will kind of help you to do this part. And you just have to think through this. Well, if I purchase something, I'm paying money out. If I sell it, I'm getting money in. So that's why some of them are positive and some of them are negative. And then cash flow from financing, that would be if you're paying dividends, if you buy or sell your own bonds in your own company, or buy and sell your own stock in your own company, or if you get a loan, or if you pay off a loan. All of those are financing activities. So any kind of money coming in or going out from those kinds of things are going to go down here in cash flows from financing. Once you get those three sections done, you're going to total the three subtotals. So here's your operating, your financing, your investing and your financing. That gives you your net increase or your net decrease. And the net increase in cash plus what you had to start with should be the ending cash. So if I have $50,100 in my wallet at the beginning of the year, which would be awesome, and I'm in a business and I made $51,775, then if I add these two things together, it should tell me how much I have in my wallet at the end of the year. So that's how this bottom section works. So hopefully this kind of gives you a process for going through the statement of cash flows. The other problems are similar. A lot of them are much smaller. They're just one particular section of the statement of cash flows, but it works the same way. So you're just going to do a particular section in some of these. As always, if you have questions, feel free to contact me and I'll help you if I can.